So, Miles, you've been working as one of our fractional finance directors for a number of years. Would you say it's possible to generalize what those businesses look like in terms of their growth journey and typically what they're struggling with?
Yeah, I think at the high level it is, and they're obviously all in different industries and kind of geographical sectors and stuff. But yeah, from a really high level, they tend to be in the 2-3 million stage at this point. So revenue, 2-3 million of revenue, looking to grow that initially to kind of a 5 million level, and then with a view out into 3-5 years up to 10 million, 30 million is typically what people are looking for. And in order to achieve that, the entrepreneurs that I work with have always taken that step back and say, well, if I need to get to that, how do I do it? What team do I need? And obviously, from my perspective, that's a finance team, but also they're looking at other areas of leadership. So they might be looking at different business models that think about how to extract an entrepreneur out of the business in terms of building those layers of management, which is a really hard journey for companies to go through. That growth piece is the most challenging of ever. And so for me, obviously, the bit that they're looking at is finance, and they're seeing, I guess, what they've got now and then what they think they need to have in place in order to get to that growth. And some entrepreneurs know that already, others don't know it. And obviously, the people that come through to me and to UK are ones that have that awareness that maybe they don't know what they don't know, and they want to get someone in that can help them do that. There's typically a number of challenges they're facing. So one is just that piece of like looking at finance is not their area of expertise. One of the things as an entrepreneur is you have to wear every hat of the business when you first start
Yeah.
out. So finance is one of those hats they have to take. If you're from a finance background, that's fine. As a finance background, you then have to put on a marketing hat and stuff, which isn't ideal. But if you're not from a finance background and you've got to look after finance, I'd imagine that can be quite terrifying for people. The entrepreneurs I work with, all of them have been, like without exception, actually been financially astute in terms of having good understanding of what they're doing. And that's why they've come and brought me into the business, because they realize what they need. They've looked into it. They're financially astute enough to realize the tools they need within their business, and that finance is so fundamental to that. The thing that makes them stand out, the people that I work with, is the understanding that finance isn't just bean counting. I think I don't know if that's like an 80s or 90s thing, Kate, but like certainly when I started, which wasn't in the 80s, 'cause I'm not that old, but yeah, when I started, I might look it, but
Are you
yeah,
sure?
when I started out, accounting really had this thing of being bean counting, and I did SEMA as my accounting qualification, and SEMA was really trying to push that business partnering, being more than just backward looking. That's what SEMA was all about at the time, and I'm sure still is. And that's what I enjoy as accountant, is like obviously the everything historic has to be done, but looking forward. And I think having that understanding that you need someone in the business that can look forward and plan things out for you and help structure everything is really what businesses are looking for.
And not just treat it as a sort of a cost saving, trying to get your finance function as cheaply as possible. It's actually, many of the CFOs and FDs that we talk to say that the finance function ends up paying for itself, because if you've got, a really good forward looking finance director or CFO, they will be able to, tell you which parts of your business are profitable, which, and all of that bit actually ends up meaning it becomes more of a profit center than just a cost center. So,
Yeah,
yeah.
exactly. Yeah, so that kind of that concept of accountants being bean counter, I just feel like that's moved on, hopefully. And certainly the people that engage with me see it as exactly what you described, that forward-looking piece. And if done right, like you say, you're looking that the cost of finance is covered by the fact that you can, again, save costs, which is again what everyone thinks about with finance, is like, oh, you're going to get someone in finance and they're going to knock 10% off my overheads or something. Whilst finance, that is something we clearly look at, we should also, as you alluded to, be looking at how we can help generate revenue and support the revenue generating departments, as well as just looking at costs. Finance shouldn't just be bean counting and cost saving. That's all part of it, but the bit where you really add value is the follow on. And I think there's kind of that in terms of do people understand that that's what finance really is, this kind of value add business partnering, supportive function, not just bean counting? And then like what information do they need? So one of the kind of classic questions I've had over the years is like, I'm a profitable business, like I could, we get, so one of my really early clients was came to me and was very much like, um, we do the accounts once a year. So I literally last minute. So it's like year end plus 9 months. This is how I did last year, which is already all that time
Nine,
ago.
9 months out of
Yeah.
date. Yeah.
Yeah. Well, 9 months plus a year, really,
Yes.
if you're looking
Yeah.
at
Yeah.
month
Yeah.
one.
Yes.
So looking all that way back. So it's only at year end they really get a true position of where they are. But they've got a general feel that they're profitable. I'm not quite sure how they had a general feel that they're profitable, but they did, but they kept on running out of cash and they had no early warning for the cash either. So it would just be the lady that was looking after their accounts in that situation was just like, we haven't got enough money to pay wages next week. And that was it. Like that was all he was getting. But in his mind was running a profitable business. And when he got his year ends, he was running a profitable business, but he couldn't like tie the two together and was like hugely frustrated. And yeah, and so that as a challenge is one that comes up. It kind of crops up from time to time as a regular problem that people have, this cash versus well, I know I'm making a profit position.
And what would you say that their biggest misunderstanding is about that? Obviously, there is a misunderstanding, but is it the tie up in the working capital, or is it the fact that they don't understand that if they buy an asset, that's all, unless you put on finance, then all of that cash is going out, and then but you're obviously seeing that cost going through your accounts as depreciation. What would you say are the sort of the biggest things that they're not understanding?
Yeah, I think it falls into two categories as you've laid out. So one is the difference between profit and cash, and that's kind of an accounting technical thing, which I'll talk through, but without I'll try not to go in the
Don't,
weeds
don't
of it.
lose don't lose our
But yeah,
audience, Miles.
yeah, exactly. Yeah, let's like bore everyone to death. But yeah, profit
Yeah.
profit versus cash, and then timing really, because that's like the other big angle. So we go profit versus cash. So profit fundamentally is like revenue and costs. Like so, revenue less costs gives you your profit. There's lots of technical bits in around that, which I'm not going to dig into. But when you compare that to cash, your profit doesn't include repayment of debt, for example. So if you've taken out a large debt and you're repaying it, the interest on that debt is included within profit before tax, but it depends where you're looking at your profit level. But the capital repayment isn't. So if you're spending 10 grand a month, 50 grand a month on repaying debt, you won't see that in the profit number. And then the other big one, as you said, is kind of capital. So if you're buying capex, investing in machinery or equipment, that raw cost doesn't hit the profit. It does right at the end, but it doesn't hit the profit, and the profit that you're probably looking at, like operational, it goes through as depreciation. And but on the flip side of that, through your bank, you might have 100 grand of cash going out to buy some equipment, and in your accounts, you could potentially, depending on the asset, have £10,000 spread out over the year, and that's it. And it's because it's spread out over 10 years or something. So you can have a real disparity between those two. So when we look at cash, we consider operational cash flows. So that's your kind of your P&L flows. You've got tax, so things like corporation tax is due a lot later. So depending on when you're making that profit, you've got to make sure you've got that in the pot for later on. VAT typically is quarterly, which can be really lumpy for business. Some of the business I work with, it's over £200,000 every quarter. If you're not prepared for that, that can be a real shock. And you could be thinking you got loads of cash and then suddenly that disappears out the door. So those kind of categorizations are really important, understanding the difference between profit and cash. And then the second group is timing. And timing is really about having a sale and then seeing when the cash comes in for that sale. So you could record the sale straight away in your accounts, but you may not receive that money for 2 months. Like some of my clients are on like 90-day terms with their customers, so they can recognize the sale and not get the money for 90 days. Similarly, like costs, quite often you might prepay something, so you might pay £10,000 for an entire year, and that money goes out your bank straight away, but in the P&L you will spread that over the months. Similarly, actually, you have that for revenue. And again, this is an area I've seen quite a few challenges with, is people not recognizing their revenue properly. So in accounts, we have this concept, again, accounting terms, but called matching. And it's quite a simple concept, really, which is within a period, and normally we look in months, within that month, you should match your revenue and costs to the activity of the business. So what you're doing in that month, what's the revenue related to that activity, what's the cost related to that activity, and that just gives you a really clear view of your actual profit for that time period. Where that's different is if you think of some kind of like a project, and again, I work with quite a few businesses that are in that project space. It's really common to take maybe a 50% deposit and then maybe a 30% milestone and then a 20% right at the end. So you've got 3 lumpy invoices, but the work on that is potentially like straight line, very rarely straight line in reality. But if you pretend the work was straight line with 3 lumpy invoices, you can see there the difference between the cash flow, which is the lumpy invoices, and the revenue, and then the activity that's supporting that revenue. So you've got all these different layers which will move things around. And that's where like you need someone with that knowledge and ability to understand that those concepts and then make sure that the business is like demonstrating it properly. And I think of all the things that I've changed in the businesses I work in, that concept of spreading revenue in particular is the one that a lot of companies have missed. So most people are happy with the concept of spreading costs, which is accruals and prepayments. It's less common for people to spread their revenue in the right way, and I've had to fix that in a number of companies I went to. And what it means if you're not is you could have a January where you've invoiced for loads of projects, looks fantastic. You deliver those projects in February and March, but you've already invoiced. There's no revenue coming through anymore, so they look terrible. So you get this kind of crazy curve in your business, where in reality, if everyone's working in a continual way, your revenue would be kind of flat, and therefore it would look a lot less bumpy, and you've got a much truer vision of your business rather than this kind of roller coaster of, oh wow, we've had an amazing January. Oh no, February's terrible. March is terrible. Oh, April's great again. Like, those are the problems that people face, and they can't understand why. And it, like, fundamentally, we have to think, well, who cares? Like, so what? It's just an accounting concept. Who cares about matching this stuff? But it really matters, because it tells you whether the operational activity of your business is profitable. So in that 1 month that you're looking at, the revenue relating to that month and the cost relating to that month, is the revenue bigger than the cost? If so, we're making a profit. You can't do that with lumpy invoicing because you've just got no clarity of that. So it's really important to line those things up. And yeah, it's one of the biggest challenges I've faced, I think, with either that kind of misunderstanding of cash and profit, and like we said, the categorization and the timeline, or this matching concept in accounting, which does, I understand like accounting concepts can be like super dry and difficult to understand, but the fundamental of making sure your profit and like your revenue and costs and profit are in the right time period, it's really transformational in the business, because you can stop panicking at the times that you think are bad, but you can also make sure you're not overly positive just because you've invoiced loads. And I think that's key, like fundamental, to get those 2 concepts really clear in your business.
No, 100%. And interestingly, sort of anecdotally, I sort of know that business owners will make decisions about, oh, let's go and spend money because they think that they've been really profitable that month, not realizing that actually, the next couple of months they're going to be loss making. So they kind of
Yeah,
make
exactly.
decisions based on a overtly profitable month that actually hasn't happened. So yeah, which is another reason for sort of spreading it out.
Yeah,
What was it? So
yeah.
go on.
And equally, sorry, yeah, sorry to interrupt, but yeah, equally you have like the over optimist or the over pessimist. So someone will, yeah, be overly optimistic when it's good news, or overly pessimistic when it's bad news. And in reality, what you want is more of a middle ground. Similar kind of problems. So.
I should also mention there that there are some new accounting standards that will be applying to smaller businesses that actually slightly go against the concept of the matching, don't they? In terms of like the revenue is getting looked at by actual sort of when the sort of the completion of the work is done versus the costs being incurred. So there is a slight mismatch, I think, coming in terms of the new accounting standard, but I will
Well,
leave that
yeah,
probably to a technical expert rather than I'm just
yeah,
sort of
exactly.
aware of it, but.
But I also think so. What you've raised for me is a really important point, which is what you've just described is your year-end position for statutory accounts.
Correct. Yeah.
What's relevant to me, and like statutory accounts are clearly relevant, but what's relevant for me is someone who's works with business owners and makes sure operationally we're doing the right thing, is that you do it what supports your business decision, which I think is what I would call proper matching of revenue and costs.
Correct.
So if there's a statutory rule at the end, then we can work for a year-end process only to adjust that. But from a business perspective, it's like what I always say to people, like it's always like the so what. So if we're going to do all this stuff, we're going to spend all this time like deferring our income or accruing for income and spreading stuff all over the place. Like, so what? What's the point of all of this? Why are we wasting time and money doing it? And it has to be to support a decision. So the only reason we want to do any of this stuff is if it supports a decision on a weekly or monthly basis that helps the business get from where it is now to where it wants to get to. And that's the only thing that matters to me. So whenever I think about those decisions, I'm trying to think of what makes a difference. And a good example, actually, and again, it's a little bit in the weeds, but just recently I've been looking at payroll accrual. So within payroll, depending on the type of the business, like if everyone's in an office working normal times, you just record your salaries when they land. But in certain businesses like hospitality and sometimes in projects, you sometimes want to accrue for holiday as you progress through a year. So one of my clients shuts down in December for 2 weeks. So in order to deal with that, we could either just have December as a bad month and just say, well, revenue's poor, the costs are all the same, it's a month's worth of salary. The fact that they're all on holiday for 2 weeks, we'll just ignore that and budget in that way. Or you build an accruals process, which like for every payroll is accruing a cost, so you can then build it up and release it as you go through the year, particularly in December, which then makes December look a lot better because you've got less payroll costs because you're releasing the accrual into that month. And for me, in that point, I'm trying to balance bureaucratic process, which is actually quite difficult, like conceptually easily, but to actually run that through your payroll all the time is a pain, versus like decision making. And where we got to was to say, well, let's just adjust the budget. So let's budget for a loss-making December. We know everyone's on holiday. Everyone is part of the business. We know that's true. So when we get to decision making, you go, yeah, but as long as we're in line with budget, which we expected to be poor, we're fine. And that's where you have to do that. So what? Like, what's the point in doing these things? Why would we bother? So yeah.
I'm so glad, Myles, that you ended up with that decision, because I'm dealing with exactly the same with
Okay.
one of our clients, and I've gone with the let's just budget for a poorer sort of December, January,
Yeah.
February. And as you were talking, I was thinking, oh no, what if you decided to
What's
go
Miles
for
going to
the
say?
overly complicated
Yeah.
accruing for holidays? And I was thinking that wasn't the decision that I came to. So
Yeah.
yeah,
Very in
really, really
line.
interesting. Yeah, thank
Yeah,
God.
but what I would say is the hospitality of businesses I work in, you always accrue it because you're looking. So if you take a pub, for example, you're looking on a daily basis at your payroll cost as a percentage of revenue. You can't have like 4 of the team on holiday, so your payroll cost is high. It just makes no sense. So in that kind of industry, you have to, but it's built into the software for them. Like the payroll software is all geared up to do those accruals. So, it's fine. In the project world, it's a slightly more of a nuance, and there is a decision to be made there. Like we both made the same decision, which is go simple and go for the budget and kind of align it in that way. Because in reality, in the December there will be less invoicing as well, so it is actually truer position that you're going to be invoicing less. So you want to kind of like visualize the fact that you're going to make a bit of a loss. That helps a bit of mindset as well. But
Yeah,
yeah.
no, exactly. Just sort of going back to the whole cash flow forecasting thing. One thing we didn't sort of touch on was, how often should the business owners sort of be looking at a cash flow forecast, would you say? So we're talking about like the forwards looking forecast rather than cash flow statement, which is telling you historically where your money has been spent. I think it's important to sort of distinguish between the two there.
Yeah, absolutely. Yeah. So it's kind of one of the fundamental tools that I always put in. It's a fairly obvious one to put in, but yeah, cash flow forecast. So typically 13 weeks out as a minimum. And then I usually, like always actually, have a much further view. So once you've got a budget, you can then extend that way past your 13-week kind of short window. And with the businesses I'm in, we report weekly. So the financial controller will prepare that cash flow forecast on a Monday. So all my clients use Zero. So bank rec on the zero, get that all cleared up, make sure everything reconciles, we're happy with all the transactions, do all our core controls. Once we know everything's fine, straight onto a cash flow forecast. That's then forecasting out, but it's also a kind of looking at what happened last week. Was last week how we expected? And then again, looking forward then in the next short window to see where we are. And there is an element of like depends on the nature of the business. So some businesses have £1 million in the bank. Their weekly movements of cash are like relatively small, and therefore they're in a fairly comfortable position. I still recommend doing that weekly, and that's what I do with my clients, even in positions where they're in a really comfortable position. Clearly, if you've got 100 grand in the bank and your weekly output and input is around 50 or 60, then you need to be almost daily looking at this stuff. And I've been in that position with clients where things have got really tight, particularly during COVID times, and we were looking at stuff like daily, if not into daily, to try and work out how we're going to balance stuff. And those are really stressful times, but doing it every week, even when things are good, gives you the discipline and the rigor and the information that when things, sadly, these things happen sometimes, we get a bit tight on cash. If you've been doing it weekly with rigor, then when things do get tight, you're fine because you know everything so well. And I have like a clear way of reporting that. So my clients use like a mixture of Slack or Teams, and to keep that visibility and to keep it in kind of the key, typically the entrepreneur, but also other members of the senior team, if we've got a broader team, to keep it in their eye line. Every week we have like some key metrics that go out. So cash in compared to what we expected for the week. So is that as we expected, up or down? Just as and then you have a rag, up or down arrow, with the numbers and an explanation. The end balance, whatever that is, so it might be the end of 13 weeks, it might be a year out, it might be the financial year end. One of my clients is literally 2 years away. We set that in stone at a point in time based on a budget, and then we're monitoring that number in the future to see where it moves, because that's a longer tail to see where it's up to. So we measure against that, and if we're up or down, we explain why. And then also a really important one is the interim. So you can look at what happened last week, and you can look at the future, and the future might say you've got £1 million in the bank, but you can't miss the fact at some point in the middle might go minus 300 grand or something. So a real classic is like that, isn't it? Or like a massive corporation tax bill that you'd forgotten about or something. If you've got a big corporation tax bill, you should have made a good profit, so hopefully you've banked some of that cash. But that can be really tricky, obviously, because you can have like real lumpy quarters. So again, it's that very short term, what happened last week, which is a really good indicator of just like making sure we've got a good measure, looking out to some future date, and then looking at your lowest balance in that timeline, so that you're just really clear, like if it's ever going into a danger area. So again, some clients, we set a threshold. We've got current account, savings account, and we might say we want 3 months worth of cost base always available. Well, like we can't have the balance going below that. So if it ever drops below that, it flags, and we're saying, right, we're projecting to drop under. That's quite a nice place to be. Not everyone's in that space. Some people, they're just trying to survive cash wise. And so you're trying to go like, how close are we getting? Are we setting like a 50 grand threshold to say, if we're getting under 50, then we're in, like, we need to be looking at that to see if we can move things about, or, checking our assumptions. And alongside those 3 KPIs, I also put a chart in. So just a line chart showing how that flows out, because again, it's nice to visually see that movement over time of your cash balance. So is it like in a solid decline to a point, or is it like lumpy? What's the trend of it? Is the trend up or down? So those things are a really helpful way of getting out in front of everybody. And by doing it weekly, you just avoid that kind of terrifying situation of everyone suddenly realizing you're running out of cash in 2 weeks' time. So by doing it with rigor every Monday, always goes out the door, top priority, it goes ahead of almost everything else, unless you've got some kind of emergency, and getting it out into Slack or Teams just like really helps. It's a really useful way of doing it.
So you mentioned you define that point in time that is set in stone and that doesn't change, but as time goes on, you're getting closer to that point in time. At what point in time do you then go, right, we need to now change that point in time to, 2 years again in the future? Is it like a month before? Is it 6 weeks before? Does it completely depend on the business? But obviously you would need to then reset it because you then got to have that visibility again into the future.
Yeah, exactly. Yeah. So like for me, you always want 13 weeks of visibility. So you should always
Okay.
have that, whatever. And then really it's down to budget and reforecast cycles. So depending on what you're doing, if you're doing an annual budget, which maybe you do 2 months before the year end, hopefully that soon. Maybe you're doing like rolling 6 monthlies, which is one of the things I do with one of my clients. So you've always got a year of budget effectively or reforecast because you're just every 6 months jumping along. So that means you've always got that long visibility. And obviously, when you're doing that, so much changes like reforecasting and stuff. So you need to have that reforecast rigor in there as well. But yeah, as a minimum 13 weeks, you should always have that timeline. Which it's like a 3 month window, which covers your VAT bills and all that sort of stuff. But ideally, you'd always have a year out. The reality, obviously, most businesses budget once a year, like in reality a couple of months before year end. So, you're getting to that point where you're getting tight on that forecast. But as long as you hold 13 weeks, now, again, when I think of like the businesses I work with, some of them, it's like the costs that are going out is just a payment run of 40 grand a week. And that's typically what they do. Or, generally invoice receipts is 100 grand a week or something, go quite high level. Other people go like super granular on stuff, but you can, if you haven't got a budget yet, you can still look back at your cash flow, talk to each other, understand what, if it's staying fairly flat, you can just copy the last 3 months and put them across. That's more than nothing. If you're in a growing business, you can obviously need to factor that up a little bit. But yeah, long-winded way to say, like, ideally, you've got to keep the 13 weeks, and then depending on your budget and forecast cycles, depends kind of what you get.
Yeah.
It's one that I have found a couple of times where it starts to tighten, and you realise that you're getting like under that 13 weeks, and you've just got to be a bit careful you don't get caught out by that. It's just the reality of business is whatever your plans are, you can start the budget process. Some kind of crazy spanner comes flying in from the side and budget gets parked because budget is really important until something operational comes up, and then budget doesn't
Sure.
matter at all. So, but what you can't do in that situation is take your eye off cash flow, because that spanner that's coming flying from the side could well be knobbling your cash flow as well. So for finance, I always have that Monday rigor, which is get the banks reconciled, controls done, and get the cash forecast redone so that we're happy. And that's like unless something really terrible is happening, that's a must do. So.
And I mean, we've probably sort of touched on this, but it'd be good just to explore it a bit more. We've spoken about sort of year-end adjustments to, get your accounts aligned with, your sort of the accounting standards that apply to that business. And, some of them are useful, some of them, most of them aren't probably. But, why are there still surprises when a business has an external accountant, would you say?
Yeah, so when the businesses, whenever I come in, I have these kind of put in the budget, cash flow forecast, management accounts, kind of core, make sure everything's sorted, core controls are done. But then I look at like as a piece of the business, understanding like when you get, because we talked earlier about deferred income where you spread your income over the time that you're delivering it is one of the things that quite often is only done annually by businesses because
Yeah.
they see it as a statutory only adjustment. And what that means is you get to year end and maybe you like everything looks fantastic, and then you defer 100 grand of your revenue. So you've got like maybe you've made 100 grand of profit, but then when they do the accounts, they take 100 grand of revenue and just take it off because it belongs to next
So you
year.
make
And
no
suddenly,
profit.
suddenly you've made no profit, and you're sat there going, "Hang on a second, I thought we were making loads of money, and now we haven't got any profit." And it's those kind of adjustments where anything that the year end accountants are moving around, particularly time wise, or creating a cost that wasn't there before, for example. So it's typically a small cost, but things like year end accountants fees are something that quite often are ignored until you get to year end, and then obviously the year end accountants accrue for them, as in
Yeah.
they put that cost into your accounts, and then suddenly you've got in some cases 10 grand's worth of accountancy fees depending on the size of your business if you've got an audit and stuff. So businesses I work with, it's always once we've got all the core priorities done, it's looking at what adjustments are done at year end and basically doing those every month. So my recommendation with any finance team is to make a month end the same as a year end. And there's always a subtle difference. There's always certain things that only come up at year end. At year end, you have to save down loads of files and documents, which I'm not saying you need to save all that stuff down every month, but the fundamentals of, if you were to roll over to month end at the end of your year, you should be able to, within a couple of weeks, go out to your statutory accountants and say, everything's through, we've checked everything, we're good to go. And like I say that, I've literally just done that with one of my clients where we've already wrapped up the accounts from our side 2 weeks into a new year. And that's that's the kind of gold standard for me, is that you can get to that point. Now, there are a number of things that might delay that. So quite often, like, supplier invoices are a classic, where supplier might actually not send you the invoice for 3 weeks. So we want to hold on to our accounts for a little patch. But what I'm getting at is you shouldn't be posting tons of journals, which are what accountants do to move numbers around within our accounts. You shouldn't be needing to do many of those as part of your year end. So typically year end should be, there's always little things. So there's always little things that need to be moved about, but it shouldn't be like a 5-page journal report at year end. Most things should be already lined up and good to go. So those kind of classic things are the matching concepts that we talked about. So deferred and accrued income, costs, so accruals and prepayments, things like assets and depreciation, making sure your assets are reconciled to your fixed asset register, getting depreciation, amortization posted properly, like debt, interest, and capital, making sure that's all moved around in the right way, so that's all lined up. Dividends are properly recognized, all that kind of stuff, so that every month you're doing that and you're lined up. I also recommend accruing for corporation tax, which probably isn't too controversial, but if you're profitable, if you can accrue for corporation tax every month, then in your accounts you're seeing what that liability is building up to, and it means on your balance sheet, which is your effectively showing you what your business is worth from a net assets position, should include the fact that you need to pay corporation tax off to HMRC. The challenge with corporation tax accrual is it can be a little bit complicated depending on a number of factors, like kind of fixed asset purchases with all that sort of stuff, which can get a bit messy. If people do research and development claims, that also has quite a swing. And then you get things like if you've brought forward a loss from prior years, like all of that can get quite complex, which again is why a good financial controller or finance director can help work with you and your year-end accountant to prepare all of that, so that on a monthly basis you have a true view of your business, and then when you get to year end, it should be a really smooth process. That's the plan anyway.
No, 100%. And I mean, you've sort of alluded to the fact that this sort of stuff should be happening monthly, and so therefore the business owner really should be reviewing sort of management accounts monthly and all this information. But what sort of questions would you suggest that they should be asking when they're looking at, assuming that they have a sort of a decent sort of set of management accounts to look at?
Yeah, great question. So like the kind of cash future position is one to always question and dig into, because as an owner, you can look at a number and understand it for what you understand it, but it might be that your financial controller or bookkeeper has made some terrible assumptions in your forecast. So you should always challenge your cash flow forecast. I know that's not classically part of your management accounts, but one you should definitely dig into. And then as you go into like management accounts, the fundamental first point is to have a budget, which we haven't really talked about much yet, but build a budget with the understandings of where you think that business is going to go, and understand the levers in your business that will create the revenue and control the costs, and if you've got the right costs associated to the revenue that you're expecting. And then what that means is you've got context when you get into month end. So when you've got your month end numbers, if you haven't got a budget, the only thing you can compare against is like last year or last month, which may not be a good comparator. If you've done a thorough budget and you've been involved in that budget process and you believe in that budget process, then the numbers that you're comparing against at a month end are numbers that you're expecting to see. So if you're seeing a variance from those, that's where you should be challenging. If you believe in the budget, then it's only really the variance against the budget that matters. And I always look at current month, year to date, and then a full year forecast. So current month is obviously the month you're in. Year to date is all the months in the financial year to this month. And then the full year projection is the actual months you've done. So like a monthly trend of actuals, plus then a monthly trend of your months still to go. So your forecasted months, which can just be your budget if you haven't reforecast. And then at the end, you add all of that together. So basically year to date actuals plus year to go forecast. And then I always get people to focus down in the bottom right corner, which for me is EBITDA profit for full year. So what did we say the full year EBITDA would be in our budget?
The budget.
What is our forecast version of that? Has that moved or not? So for me, that one metric is the fundamental one to look at, because that's your line in the sand, which is saying this is the EBITDA we said we were going to make. Now you've got this is what we're saying we're going to make now. Everything else informs that then, which is like, well, how have we done year to date? Oh, well, all of those problems or all of the benefit was prior months. And we talked about that before. Or this month has been amazing or terrible, and that's going to have swung that number. Or we reforecast up or down, and that's going to have swung that number. So that one single number holds loads of information. And then what you need is someone to explain that. And typically I do that through a waterfall chart, which is a really nice way of saying, here's a starting number, here's the ups and downs through like a waterfall concept, and then here's the number that we're ending on. And then each of those blocks, up or down, has an explanation to say, revenue in this channel has gone up, revenue in this channel has gone down, therefore the net revenue is this position. And then same with costs, and just saying where we are. So that single number, but then with all the context of everything else, is key. And it really depends on the nature of the business. Again, some of the businesses I work with, we've gone departmental. So you've got like department heads who are accountable for their own budget. Other companies, it's more straightforward, and it's just like a block of accounts that the entrepreneur is owning. So again, if you're the owner of a business and you've got department head accountable for a set of accounts for their own department, then you should be asking those guys the question, like, what's the up or down in your area? I need you to explain that to me and like talk me through the operational impacts of what that is that's causing that up or down. So yeah, it really depends on the business, those layers, but fundamentally that view of current month, year to date, full year, focusing down on that like EBITDA number. And EBITDA is an interesting one. So I know different people have different views on this. Kate, what's your view on EBITDA? Some people get really upset about it, don't they? But you a fan of EBITDA? Oh.
I'm an accountant by trade, aren't I? So like through and through. So I like the overall complete position, which includes obviously like the interest and depreciation. So for me, I don't feel that you're getting the full picture. I think that obviously that is the focus that investors look at, because they are looking at like your operational profit. But I kind of like the complete picture, but maybe that's just my nature. So
yeah, and I guess just for any listener that doesn't know what EBITDA is, so EBITDA is earnings before interest, tax, and depreciation and amortization. So the reason I use it in the business is so we always show below that in the accounts, but I focus on that number because it's equivocal to like a operational profit.
It's your operational profit, exactly.
It's going to be an operational view, and everything below that is like interest, depreciation, and tax, which aren't operational. They are definitely impacting your profit for the year. Like, we mustn't ignore those, but you can't really influence them that much in terms of your day-to-day operations. So when I work with businesses, I'm focused on the operational levers in the business that are going to make a difference. And like, my head of whatever department can't influence the depreciation I'm going to pay. I mean, they can, because they could buy less capex, but they're not going to impact our tax unless they make less profit, and like interest, because it's usually directors are going to make that decision about capital. So that, we can all influence those bits below EBITDA, but really, I guess what I'm focused on is like operationally, day to day, what can the team influence, and that's your revenue, direct costs, and overheads. And so that's why I like EBITDA. But yeah, I mean, I've seen lots, particularly LinkedIn's like a hub for people to get really angry about stuff like that, where keyboard warriors and all that. So yeah, some people hate EBITDA and say it's like disastrous, and if you focus on that, your business is going to disappear. For me, it's like focus on EBITDA, but still have the lines below. And I report those every month, but don't ignore them. But EBITDA is the one I ask people to focus on.
And I think that is right. I think my point was that there's a danger that if you don't have your interest, depreciation, tax like worked out below that line, then they're going to be errors in all of your numbers. So like
Yeah,
you can
absolutely.
sort of completely miss like actually focusing on that, and then everything else is completely irrelevant. So but yeah, I think it's a good metric in terms of what to
Yeah.
focus on for the business. But
Funny enough, it
yeah,
goes back to the question you asked me earlier, Kate, which was, so you asked about the year-end change, and EBITDA is a perfect example of that, actually. So if you just focus on EBITDA, you could make a lovely profit and be really happy. And then you get like, some of the businesses I work with are very capital heavy, got a lot of debt to support that capital. And you go, EBITDA, amazing. And then you go, right, wallop, here's my depreciation and here's my interest on all my
exactly.
like capex and stuff, and suddenly that amazing EBITDA gets watered down a fair chunk. So yeah, there's a perfect example of what you're saying, which is you need to keep an eye on all of those things.
The complete picture. Yeah, no,
Yeah.
exactly. Um, so in terms of, actually, so when you were talking, I suddenly thought of something that was really important to say, and it's fortunately just come back to me in time, which was, and you've touched on reforecasting, budget, etc. But it's really important to make that point in that if your business is, got halfway through the year and something fundamental, I mean, I know you do reforecasting with your clients probably quarterly with most of them, but you sort of said, oh, just use budget if that's what you've got. But if something is fun, there's a lot of pivoting going on at the moment with the economy, etc. Lots of businesses sort of trying different things and investing in new technology or whatever else. If something fundamental has changed during the year, there is no point in blindly follow. I know you weren't saying that, but I just want to make this point: is that you've got to relook at the assumptions you've got in your budget, and if you've now got a massive cost relating to a platform you're now using, then you've got to make sure that then is factored in that future forecast. And that's where you alluded to the whole reforecasting point is very important. And I know one of our other fractional finance directors, Steph, has sort of said, like she quite often doesn't even compare back with budget at all. If fundamentally, she works with a lot of charities. If some grants haven't come in, there's no point in then each month saying, oh well, we're under this or we're over this because of that point that I've said every month for the last 6 months. So she will end up like just sort of saying, okay, well, let's draw a line in the sand and then let's look forward at this new forecast. So yeah, I just wanted to sort of make that point really.
Yeah, it's a really good point, and again, it really depends on the nature of the business, the size of the team, like the impacts of stuff. So some businesses I work with like monthly reforecasting because they're relatively simple to do, others quarterly. I like you said, I 99% of the time hold to budget is my kind of final comparative because it's like that's what we set off the year trying to target. But there is a point where you say, okay, like we're all grown ups, we know this thing's happened, but there's nothing more frustrating in a meeting than every month saying the same thing. Oh yeah, we were going to achieve this budget, but yeah, we're not now because of these five things. You might as well just cut that conversation out. But some way you do need to record that because the flip of that, I guess, is that you reforecast down, reforecast down, reforecast down, reforecast down, and then you celebrate hitting those reforecasts, and actually you've like decimated your position compared to where you started. And that might be the reality, but as a leadership team, you do need to keep a little bit of a view on like where you were setting off. I think your example is quite different in terms of like not getting an enormous grant. Clearly,
Yeah,
that's like kind of semi out of control. Whereas,
yeah,
if your revenue in one channel just keeps on degrading, you can forecast that down, forecast it down, forecast it down, celebrate hitting it. Everyone's like, oh, this is amazing. Like the person leading that channel is doing a great job. And then you realize at the end of the year, you're like £500,000 off what you set off to do. So there's a balance in it. And there's also a balance in time because you can kill a finance department by reforecasting every single month. Everything, every
yeah.
time again, you get an interesting balance in businesses where some people will like reforecast because something moved by £5, and other people won't bother unless it's over 100 grand or something. And again, you just need to find the most sensible balance in there. One area that I always focus on reforecasting monthly is like in cost base where you haven't spent something, because that's one of the areas you can get caught out in. So if you were planning to spend 10 grand on marketing in the month, and then that we haven't spent the 10 grand, but we're going to spend it next month, I get my financial controllers to move that over,
Yeah,
reforecast that cost, because otherwise it kind of
it
vanishes.
gets
If you
lost.
look to your full year position, you've just saved 10 grand, but you know full well you're going to spend it next month. So it's all of those little things, and it just depends on the business. But again, I always go back to why are we doing this? Who cares? What's the point? Why do we do a budget? We do a budget so we give context to our actuals, so we can hold ourselves accountable. Why do we reforecast? Because something's changed. We need to like hold ourselves accountable to a different number. So any of these decisions have to be made in terms of, well, what decision is this thing going to help me make? What information is it going to give us as a team that's going to make us like perform better? Don't just do any of this stuff because someone said, like me, oh, you must reforecast every month. It doesn't make sense. Just don't do it. Like, but
Yeah.
if it supports a better decision, then you need to do it, and that's the fundamental. One last point on all of that is if you're reforecasting your profit, please don't forget to reforecast your cash flow, because you bring down your profit, maybe you're saying sales is dropping off, you have to get that into your cash. Like that's more important to reforecast your cash than it is your profit, because the cash is where you're going to get caught out more than profit.
Yeah,
So yeah,
in my
really
head, I
important.
was naturally doing that reforecast thing in terms of the P&L, and L, and then I was taking that and then I was putting it into that cash flow forecast.
Exactly.
But yes,
Yeah.
it's good to actually spell that out because
It's an
yeah,
important
not everyone.
cycle. Yeah.
No,
Yeah, for
exactly,
sure.
exactly. So I mean, if there's a founder that sort of or business owner that's sort of identifying, some of these pain points, where
Yeah.
do you think they should start? As like they're sort of they're conscious that maybe they're running the business just looking at their sort of prior year statutory accounts and sort of looking at their bank balance and having a sort of a plug in the air in terms of what might be coming in. Where should they start in terms of just trying to get some control over their finance function?
So funny enough, the first question I always ask is kind of like, why am I here? And the reason I ask that is like, why are we having a meeting? And it's funny about, well, where do you want this business to go? So depending on where you want the business to go is going to answer the question that you've asked, Kate, really, which is if you're looking to grow your business significantly, or actually you're looking to keep it nice and stable, that does change what you need from finance. Because if you've got a nice, comfortable business, not that many transactions, you can probably get quite I was about to say junior level. That's really insulting, but a kind of a fairly, what's the right word, Kate? A nice, comfortable level of finance where you can have like a bookkeeper that makes sure all of your things are in place, maybe a couple of days of a financial controller just to give you the information that you need. Whereas if you're going on like a large scale growth, I'm then recommending a much fuller finance piece being put in place. So question one for me is like, just take a step back and think about your business and go, where are you planning to take this? What do you want to do? Like, do you want to go out for big investment? Do you want to go out for sale? Are you just going to keep it as it is? Are you looking for growth? All of those things change the kind of finance team that you need, because you, like I say, if you're keeping a very stable business, no growth, you're not looking for investment, you're not looking to sell, you can keep things pretty simple and, just kind of keep going as you were, really, let's be honest. But the moment you want to go out for investment, you need to have a good set of accounts for that. The moment you need to have a good forward forecast as well, that's been really thoroughly looked at and people will believe in. The moment you want to sell your business, again, I've talked about making a month end like a year end. One of my other mantras is make your business ready for a venture capitalist. And that doesn't mean you have to sell to a venture capitalist, but I hold that as I've gone through a number of sales now, and because I've gone through the process of like, let's get finance in a position that if a venture capitalist came in, they would look at your accounts and say, okay, great. So like due diligence is always horrendous. Let's be honest. I've been through a few, like however good your information is still a journey. But what I've always been really proud of is that finance has always been like the simpler part. It's been people have looked at the finances. There's no skeletons in the closet. Any skeletons have kind of disappeared over time, and everything is clean. The accounts are clear. Your forecasts are good. That means any investor or anyone who's going to buy your business or any of those kind of things, when they look at it, they see finance rigor. They see a structure in place. But if you're not looking to do those things, you don't need to go quite as full on to do those. So, like at a simplest level, just make sure your accounts are in control. So, you know, all my clients use Xero. Some clients use Sage, that I do like financial modeling for, but the ones that I FD for are all Xero. So good solid finance platform. Make sure, as a minimum, you're reconciling your bank like regularly. Get that cash flow forecast done for 13 weeks, and it can be relatively simplistic if you're a stable business. Get some site of a budget and some site of management accounts. That's like stable, nothing changing, maybe in like the below 1 million kind of bracket. The moment you break out of 1 million, I think you need to take finance a bit more seriously. And at that point, start thinking about like, what do I need? And it can be really hard. Like I say, some entrepreneurs have a lot of that finance rigor and understand how these things work. Some don't, and I totally get it. I'm a finance person who I run my own business doing like training spreadsheets and stuff, and I have to do marketing and sales and things, which I'm like completely out of my comfort zone doing that. It's not my skill set, and so I totally get the reverse, which is someone's got to own finance and it's not their bag. So if that is the case, then look for support. And the obvious thing for me here to say is come to Artemis Clarke, but
That's a very
having
nice answer.
someone like a fractional finance director or a fractional financial controller who's been through this journey in lots of different industries, have experienced lots of businesses, and maybe been through some sales, maybe like transformed the way finance teams work on stuff. That's what you need, is someone who's got that level of expertise. And fractional finance director, fractional finance controller is a much more common thing now. It's something that I've seen like grow up from pre-COVID, because obviously we were doing things together pre-COVID on the fractional work, but like that kind of more remote working, people looking to work a little bit more part-time, it's really common now to have people working part-time or fractional. And what I love about that is you can get a huge amount of value from a finance team that's fractional, because you can have, so my classic is over time to build a finance team that has either an external bookkeeping team who look after stuff, or an in-house bookkeeper. They're typically full-time because it's usually very granular,
It's the
repeated
processing,
work.
isn't it? Yeah.
Yeah, and it needs, those things need to be up to date on a daily basis. Then I usually have a fractional or part-time finance controller, so either part-time employed or fractional.
That's
So
how I
fractional,
differentiate between the two
yeah,
terminologies. Actually, I use fractional for, if it's, outside of employment, whereas part-time is a part-time person employed within the business. It just helps with sort of, the
yeah.
differentiation between the two
I think
types of.
the other nice word is portfolio. It's like a portfolio finance director. So basically, you're supporting more than one client. I think that's quite a
Exactly.
nice way of describing it as well. But
Yeah.
yeah, having that either part-time or fractional finance controller who is a step out of the weeds, but is still controlling all of your key accounts, is doing the cash flow forecasts, preparing your management accounts, supporting on the budget, and then a fractional finance director who is like overseeing that and making sure everything's in the right place. And I go in and I'm looking at systems and processes and like making sure everything's correct financially, but also is the most efficient way of doing stuff. That these days there's so many bits of accounting software that are not expensive but can make life so much easier, and that will only improve this year as AI starts to really like ratchet in on those bits of software. So I think getting that layer in of a good bookkeeper, solid FC, and then a finance director who's like overseeing that, but then more importantly is your right hand person to support on the strategic decisions and thinking. And I've always loved the finance director role. As I kind of see myself as that second person. I'm sure like ops director thinks they're the second person as well.
Yeah.
But from a finance, like in finance, you have a different experience of these things because you're aware of all of the financial situation, which isn't typically known by everybody. And so you're kind of in the trenches with the owner a lot. And I've been through some really hard times, particularly COVID was awful. So I've been through those times with people, and I know they value that experience of having someone, a fractional finance director level, but is like there to support through some of that difficult stuff. And I'm really good friends with all the people that I work with that own the businesses, and we've gone through a lot together. And that's what I love about it as a fractional FD, is you get into that position. But yeah, coming back to your question, Kate, is where do you want your business to go? Decides what size of finance team you need. And it also, like, you need the same bits of information. So you need to know where your cash is going. You need to know if you're profitable. You need some kind of context, like a budget to compare against. But just the sophistication of that will change depending on the size of your business, actually the nature. So what you do, service, service businesses, project services, and then like hospitality, they're like worlds apart in terms of granular transactional stuff. That will decide it as well. And then, like I said, if you're going out for investment, if you're looking to sell your business in the future, any of those things, you will, when you get to that point, if you're looking to sell your business in 3 years, if you don't sort out finance, firstly, you're going to struggle cash wise and visibility. But when you get to that sale point, it's going to be 10 times as painful because they're going to need to see all those accounts properly done anyway. So for me, it's I see it as like a finance platform for growth from a statutory perspective, from an informational perspective, and then for a supporting platform that allows the business to grow with the sight of the information they need in order to be able to get to where they want to get to.
Yeah, no, absolutely. And just quickly going back to sort of the putting in the sort of the controls and processes, one thing we haven't talked about is actually the importance of sort of month-end balance sheet reconciliations, which is sort of part of that whole putting together the monthly management accounts. But you've got to know what's in your balance sheet, because I've spoken about this many a time on previous webinars, and it's the concept of actually the balance sheet. Business owners don't really look at it very often, and that kind of the P&L sort of will fall out of a tidy balance sheet, and that is kind of that sort of sits behind the preparation of decent monthly management accounts.
Yeah, 100%. Yeah, and balance sheet's such an interesting one because it is that kind of lesser loved sibling, isn't it? In terms of
100%.
People just either don't get it or just find it so dull because it's not sales and costs. Sales and costs are so obvious in terms of what they are. I think when you get to balance sheet and you're looking at current assets and current liabilities and all this sort of stuff, it's all just terminology. Finance is actually fairly simple when you break it down, but the words can be daunting, and just looking at a bunch of numbers on a spreadsheet can be pretty daunting or dull. So yeah, like it's exactly what you said, Kate. The movement in the balance on your balance sheet from one month to the other is your movement in cash and your movement in profitability. Like that's the fundamental. Ironically, the balance sheet is the core. So when we do financial modeling, so financial modeling is where you like future forecast a full company, which is typically what you need for like an investment round or something like that, or for a sale of a business. So you maybe forecast out monthly for the next 5 years what's going to happen in your business. You build a balance sheet, cash flow, and P&L, and the balance sheet is the thing that's driving like the move into cash. So typically you forecast your P&L, flows into balance sheet, and then the balance sheet is what's driving your cash movement. So that's also true in the real world. So we need to be really clear about the balance sheet. And again, going all the way back to the start, Kate, you talked about the surprises you can get at year end. So like, I've had a really profitable year. It goes to my year end accountant. Suddenly I'm making a loss. Why on earth? One of those is that they find something in your balance sheet that you've got this big asset, as in something that's of value to you, sat there for 100 grand, and suddenly they say, well, what's this? And you go, oh, I don't know, that's been there for a few years. And they say, okay, well, that doesn't exist. So they remove that from your balance sheet. So if you take something that's worth 100 grand off your balance sheet, the other side of that hits your profit, well, your profit basically. So you're going to take out a chunk of profit. So again, monthly, part of that monthly process, and I didn't mention it because most people find balance sheet dull, is those controls that I talk about are balance sheet controls. So they're the controls that you have to do to make sure that you recognize everything. And again, if you think what a balance sheet is and why we care about a balance sheet because the bottom numbers are effectively the value of your business. So not the value in terms of if you were to sell it, but like the net asset position of your business. So everything that you own, less everything that you owe other people, is kind of laying out, this is what we have as a net position. If you overstate that position, you can't, like overstating at year end, you clearly can't do because that's fraudulent in terms of pushing out. But on a monthly basis, you're just deluding yourself to the point where you think you're in a better position than you are. And then when at year end, if that number gets changed, you can be in all sorts of trouble.
I think this is probably particularly important for those businesses that are growing and are getting to the point of needing an audit, because
Yeah.
probably you've got accounts that will have things in your balance sheet that potentially shouldn't be there. But as soon as you require an audit, those things, that is what the auditors will focus on. They will look at your assets and liabilities. Are your assets overstated? Are your liabilities understated? That's the key point of, like, the main bit of the audit. And things will suddenly be coming out of there. This is the skeletons that you talk about in the closet.
Exactly.
They will be coming out and they will be hitting your P&L in a way that you don't want them to. So it's better to, and obviously, as you've alluded to, when you're coming to sell, you want to have 3 years of really good management accounts. You don't want to be having things hiding away in the balance sheet that shouldn't be there. So particularly assets in the balance sheet. So
no, exactly. And just talking about the sale point, if you imagine that process of due diligence that you go through, which is a really hard process, even with a really solid set of accounts, or if you're going out for investment and someone, I've had it where an investor has sent in a specialist for a day to sit with me and like go through the accounts. If they start finding things that are, let's talk about, no one's doing fraud, but like if they find things that aren't right from an accounting perspective, you start to lose trust. So from an investor perspective, that's really important. You might be asking them for £1 million investment and they start to see that you've got these errors in your accounts. That's not fraud, just errors. That starts to degrade trust. If you're in the kind of sales position, again, it can start to weaken your position. It might even change the valuation if you're starting to, degrade the business from we thought it was this, and actually it's like disappearing because we were overstating our balance sheet, or whatever it is. But yeah, again, just going back to that example of an investor. So one of the businesses I was working in, they literally sent in like a trusted advisor to spend a day with me and the owner, and they ripped everything apart. So they went through everything, like cash flow forecasting, the 5-year model. They looked through the accounts. They then took all of it away for another 3 days of just like deep dive.
How did you hold up, Myles? I hope you're okay.
Perfect. Yeah, didn't find a thing. I was very pleased.
That's why I love working with you.
I'm not saying this to boast or anything, but it was like that's the way it should be. Like they should come out. They always, they're being paid, so they're going to find a few little things, and that's the reality. Like highly complex businesses, you're always going to have a few little quirks and stuff that might have happened, but the key is that they're not finding like substantial things. So one of the ahas that the advisor was looking at was on the cash flow forecast, where you kind of forecast out your cash, and when I forecast out cash, I also check the debtors and creditors balances. So I'm looking at debtors, creditors, and stock, if stock's relevant, just to see how those balances move in line with my cash, because in theory, you should forecast your entire balance sheet, but that's just a lot of work. So typically we have cash, debtors, creditors, and assets. And the reason for that is you could have your debtors balance disappear off to like a minus number, because then all of that cash will have come out of debtors and gone into your bank in your forecast. Equally, like your creditors, you could grow enormously, because then in your forecast, you're not paying your creditors, so your cash improves. So his aha moment was like, oh, let's have a look at your debtors and creditors then, because he was expecting to see some crazy thing. And I already had the chart. So I just popped the chart up and he's like, oh, okay, fair enough. And that was it. And we moved on. Whereas if I didn't have the chart, firstly, we'd have had to spend probably an hour trawling through stuff to try and create something. And then it could have been that if I hadn't had the chart, maybe my debtors assumptions were stupid and my debtors was like disappearing off a cliff, which obviously isn't a realistic thing to forecast. So yeah, again, it's just that piece of finance rigor, and it all just has to be appropriate to where you want to go in your business. If you're running a 100 grand business and you're going to stay at 100 grand and you've got no aspirations to sell it, no aspirations to grow it, you don't need someone like me to come into your business. But if you're running a £1-2 million business, you're looking to scale, you need to be thinking seriously about your finance function in terms of those 3 layers for me. So bookkeeping, financial controller, finance director, and you can get less time as you go up the ranks. So full-time bookkeeper, probably 3 days a week, financial controller, and then like typically 1, 2, 3 days a month of finance director, just depending on where you want to go. And that can be lumpier if you need, if you need a 5-year financial statement building, then that can take a bit of time to build. And I typically get brought in to do that kind of work, or sit and talk about the strategic business direction, or any of those kind of things. So you really just need someone to lead that team who knows how to structure a finance team, how to put the right systems and processes in place, put the right controls in place, and then have that team run nice and efficiently. And my point where I know that's working really well is where I get less and less involved. So I can take a client as a good example, one that we've worked on together, where heavily involved in at the start because there were a number of things that needed to be resolved, project based, no deferred income, so they were recognizing their invoices straight away, and no kind of, not the kind of site of cash flow forecast that I would recommend, and a number of things that needed to be done at the project level. And now that time is massively reduced because I've got a finance team who are incredible, and they do everything without my support. And I'm then like less than 1 day a month now supporting that client. And that for me is a success because it means everything is working well. The time I have is to dig into strategic stuff and have those kind of director level meetings where we're looking at 2-3 years ahead, not why can't we reconcile our revenue and stuff like that. So for me, the success is actually getting myself out of a job, or in one case, I've replaced myself in one of my clients. So replace myself with a head of finance, and I've now gone non-exec on the board. So for me, that fractional role is a temporary piece. If you're growing a business, I said it earlier, but you get so much value from fractionals in that patch of time where they're resolving all of those finance things, getting the platform ready for growth. And then over time, you'll replace those probably with an employee, but they should be coming into everything already solved. You can burn through full-time people if they're coming into like chaos, and then they've got to try and fix it. Whereas a fractional, that's what we do. We go in, we've done that kind of fixing for years, get it fixed, and then you can bring in like a full-time team if that's what you need. Like you may not need ever a full-time team, but if you do, I think it just holds that patch where you're in that point of growth. You've got the money available to fund a finance team. You're growing the business. You need financial sophistication and rigor, and then you can move back to employing those people, and the fractionals would move away. That's good. That's the way I see it, and it's very different in different businesses. And from my perspective, ideal is that I would then go non-exec on a board because as I have with one of my clients, I went from a very poor bookkeeping company who weren't doing a very good job at all, through to a point now where there's a team of 3 in there doing an amazing job with the accounts. Everything's departmental, cash flow forecast, budget, quarterly reforecasting. Business is on track to deliver the growth that we planned all those years ago. And now I'm just a non-exec on the board, review the accounts monthly, and that's it. But for me, it's great because I don't want, as much as I want to replace myself and get a team in, because that's best for the business, like personally and slightly selfishly, I want to be involved because I've seen that business grow over the years, and I want to, I'm invested that, as I said earlier, these times, you go through hard times in business. So you build a big bond with the people that you're working with. So stepping away completely is difficult. So, and obviously, if you've done a good job, you'd hope you'd stay on the board if they need a board person. So.
They're just really conscious of time overrunning, but one of the things that you sort of touched on there, and I think it's really important. Well, a couple of things really is that once you go on this journey, you do have to expect an investment into your finance team, your finance department. You can't get a fractional coming in, fixing everything on 2 days a month and expecting that to be done in a couple of months. It doesn't work like that. The beauty of having a fractional is that you could spread out that investment over a period of time. So if you're not in a rush to sell and you've got time to build up the foundations, then that model works well. If you're looking to sell in the next 6 months, then probably a fractional isn't going to be able to get things up and sorted in the time frame that you would then need to do, and then you'll probably look at it more as an interim full-time solution than a fractional solution. So with all of your clients, Myles, I understand is that the journey that you've gone on with them to build up that solid finance department has happened over a number of years, and then you going down to a couple of days a month is after that period of time. So it's just to sort of set that expectation that, one, there is an investment piece in terms of your finance department. This isn't just a cost effective, oh, I can get an amazing finance department on 2 days a month. That doesn't happen. And two, that actually that building up that cost base, and that decent finance team, will happen over a period of time. So I think there were just a couple of points that I wanted to make, really.
Yeah, it's a really good point. And I guess the two sides to that is the first is the timeline. If you're working on a part-time basis, you can't deliver the same amount that someone's doing 20 days a week, clearly, and not a week, that'd be impossible, 20 days a month. But also the cost of it. And I've had that kind of pushback initially where I've got an example of a client that actually a few where they were paying so little for their finance function, but it basically wasn't really functioning. And it was a false comparator to having that
Exactly.
versus a full finance function. And that's then really hard because you're trying to communicate that. And to your point, the value isn't obvious until a bit later because all you're doing is bean counting to a point. And then once you get past the bean counting, you suddenly unlock the value of finance, which is the forward looking part and the business partnering part. But you can only do those things once you've resolved the challenges that are there when you first go in. So yeah, really good point that these things don't happen overnight, and the cost of finance is likely to increase a fair chunk actually compared to what you're already spending. And it maybe seems counterintuitive that you're getting finance in and suddenly they're costing you more money when everyone has in their mind that finance is going to save money. There's a lot more to finance than saving money.
Yeah. And just one final point is, finance is often like one of the last things that a business owner can delegate. Why do you think that is the case? And and what does actually change when the founder can finally trust the numbers that are produced by a decent finance team?
Yeah, I think you've knocked it straight on the head with the word trust. I think it's trust and control because finance is everyone would say it. Finance is the most important department, but finance, like having control of your numbers, is the most important thing. Like fundamentally, whatever we say about anything else, sales, marketing, ops, incredibly important, clearly. But if you run out of money, none of those departments exist because the company's disappeared. So for any owner, particularly like most entrepreneurs, and it's one of the things that saddens me slightly, is that I don't think everyone understands the journey that a lot of entrepreneurs go through. They just see the end product where they've successfully sold their business. Like entrepreneurs can go through some very horrible times, usually on a monthly basis, and part of that is very often finance because they haven't got enough money to pay payroll, they can't pay themselves, they can't pay their bills, they've got a massive problem, and they know that's going to cause them financial chaos. So for any owner to be able to say to someone, I trust you to take hold of my accounts, and that I'm not going to suddenly find that my business has gone under because you're not doing a very good job. That's huge. Like for me, I take that on board very heavily when I take on someone's accounts with that person is giving me their trust and I have to deliver. And it's, as anyone in finance, like we take it incredibly seriously, the importance of owning someone's numbers and them trusting you with that. And that's why those metrics are so important in terms of giving them the visibility of cash every week. As I said earlier, they need to make sure they're comfortable with that forecast because I can give them any number I like to say it looks amazing. They need to trust it. But over time, that trust builds when you can prove that those numbers deliver regularly. And the same with profit and the same with year-end accounts, that if every month you're demonstrating how we've performed against budget, you can explain the ups and downs of that. You get to year end and suddenly profit doesn't disappear by 200 grand. You start to win that trust. Plus then when the bit that I really love is when I have the conversation where they suddenly get what finance is, and it's the business partnering value add stuff. And I've had this across all of my businesses where there's this sudden light bulb moment, which is, oh wow, we've got this person in our team, which is our bookkeeper, financial controller. It's not me, it's the other people in the team. They're going, oh wow, these people are amazing. Like they're highly intelligent, highly experienced, they're commercially astute, they can help solve all of these problems. They've usually got good spreadsheet skills, which is like really important in any small business. They're process focused, those are the kind of people that they suddenly go, oh, okay, they're more than just a bean counter. This person is going to help transform our business with us, and that's what I love. Like particularly like it's particularly the financial controller role because they're the person that typically business partners. The bookkeeper tends to have to grind away a lot. As
Yeah.
much as possible, try and get the bookkeepers out into the operations as well. But fundamentally, that role is a bit of a daily grind, isn't it? But the financial controller typically is that middle ground where they can get out into the weeds, out of the weeds rather, and get into that business partnering. And that's probably my favorite part of it all is when you see that light bulb moment of finance isn't just a cost. It's not just about trying to save cost in other parts of the business. Actually, it can genuinely make a difference. And yeah, that's the bit that I love the most.
So what is you've got a business owner watching this and kind of going, right, where should I start? I know you sort of said you would ask them what their ambitions are, but give them, I guess, like a tangible action that they could take themselves that would make a disproportionate difference in their business in terms of their finance department.
So for me, if you're not forecasting cash already, so that's a 13-week weekly cash flow forecast, do that. So do that and put those 3 metrics that I discussed. So movement in the week. So last week was the cash coming into your business, was it higher or lower than you expected? That forward number, maybe a year's time or in 3 months' time, is that up or down from what you expected? And then that lowest balance. So that gives you complete visibility and control of your cash. Put a chart in as well, because that gives you the visibility. But why I say that is, one, cash is king, and like we have to focus on cash. That's the thing that's going to kill you as a business owner if you don't look after it. It's the one thing you can't get wrong, because then you're literally dead in the water. But also, in order to be able to fill in that cash flow forecast, you've got 2 things. So one is you look historically, because you have to fill in what happened last week. So if you fill in what happened last week, you've instantly got a view of the cash going in and out of your business. That gives you a lot of information. But then you also have to forecast forward, and to go through the practice of looking forward and say what cash is going to come into my business, what cash is going to go out. That gives you, again, so many insights into the ups and downs in your business in terms of revenue coming in through debtors, what you're going to spend in payment runs, what your payroll costs you, the reality of the tax payment. So either your payroll taxes, which are the month after, your VAT, which is probably quarterly, your corporation tax, which is later, getting the concept of when they land. If you're not into finance already, just doing that one schedule will open your mind to the reality of your business and where things are going. Hopefully it won't scare you by the fact that the number that's going to be at the end of it, but maybe that's a good thing as well. But just doing a cash flow forecast will open your mind so much to how your business converts into finance, and how finance can help you if there are concerns there as well.
No, brilliant. Well, I think we've more than overrun, so I will leave it there. But no, I mean, yeah, I could let you talk for ages on this subject. I just find it fascinating. As I said, we've been working together for so long, and there's a good reason for that. So thank you, Myles. I really appreciate it, and I hope people listening have found it beneficial. So thank you so much.
Thank you, Kate. Thanks for having me on.